Hey, welcome to another episode of the Mark Moss Show, where we talk about Bitcoin, we talk about cryptocurrencies, we talk about the decentralized revolution, and we're trying to make sense of this out of control world as these central bankers continue to destroy any and all relationship to money, and we're basically narrating the path of destruction that is left in their wake. We got a lot of stuff to cover today as we look at the decentralized revolution that's happening in the world. Of course, that's why the world is so crazy. And we really try to look at it from the lens of three perspectives, and that's politics, finance, and technology. Of course, Bitcoin is leading that charge with the decentralized revolution. And if you understand the politics, finance, and technology and how the three of those things come together, it helps us understand where we're at today and, of course, more importantly, where we are going. That's what everyone's trying to figure out, myself included. We're at a very uncertain time. The world probably, it seems to be more uncertain than any time in history, at least that I can think of. Now, the way that we beat uncertainty is with optionality. So the more options we have, the more prepared we are for whatever may come. That makes sense, obviously. And one of the best ways that we get that optionality is with money. Money helps us have that optionality. So that's one of the reasons why I like to focus on it, so I can make sure that I have options to protect myself, my family, and so much more. And if you tune in each and every week with me, I'll make sure that you are up to date and equipped to handle the uncertainty that is facing us, that's ahead. So if you haven't already, make sure to put a calendar on your phone to join me each and every week on this same time, this same channel, so we can keep you up to date on what is going on. Now, there's a lot going on each and every week, so I love to get together and kind of explain to you what I'm seeing. And there's big news that happens, although it seems to be the same stories kind of continuing to roll over. For example, one of the things I've been talking about for like the last 8 months or so is the big word, the hottest word being used today, and that is inflation. And of course, we talk about inflation, but the way that we talk about it has changed a lot over time. It went from, as a matter of fact, I was just looking at this yesterday, 2018, the Fed was saying they can't get enough inflation. They can't get it no matter what they do. Since 2012, they haven't been able to get their inflation target of 2%. And so if we were talking about inflation back then, it was in a sense that they couldn't get the inflation that they wanted. Now, if any of you are gold bugs or sound money advocates or Bitcoin crypto advocates, then you might be asking yourself, why is there a target for inflation anyway? Which is a pretty good question to have. The Fed targets a 2% inflation, which basically means their target is for you to lose 2% of your wealth every single year. Now, why would they have a target to steal 2% of your wealth every year? That doesn't really sound like a good target to me. Nevertheless, that is their target. And so, like I said, in 2018, there's some headlines saying, we can't get it. We can't get the inflation up into 2020. We can't get the inflation that we want. And so the Fed said that we're going to, quote, let it run hot. What does that mean? That means that, we can't get to the 2% that we want, so we're just going to go in guns blazing. We're going to throw everything in the kitchen sink against the wall, see what sticks, and we're probably going to way overshoot the 2% number because we have to do everything that we can think of, and so we'll probably overshoot the 2% number, but that's fine. We're going to let it run hot. We're going to go higher. We don't care, 3, 4, 5%, whatever. And they started talking about a blended number. Well, since we've been below 2% for so long, if we get above 2%, that's fine. It averages out. And so that's what they did. They let it run hot, in their own words. And here we are, hot. We're at a high haven't seen since about 4 decades ago, since the 80s, running 8.6% CPI inflation, which is, of course, is a manipulated number. I talk about that all the time. I'm not going to dig into that. But again, so we're talking a lot about inflation. Now, why do we talk about inflation when we're talking about the decentralized revolution? We talk about Bitcoin and cryptocurrencies. Well, the big reason why is because all of these problems that we have, are we going into recession? Are we going to see stagflation? Will the markets crash? Will the markets go back up? All of that revolves around the central banks, the Federal Reserve, controlling the money. If they increase the money supply by lowering interest rates, then we have boom times. Things are great. Business is booming. You're buying equipment. You're expanding your business. You're buying bigger houses. You're getting new cars. Everything's happy. Everyone's happy. Everything's good. And when they decide to then restrict or decrease the money supply, things go very badly and everything crashes and you lose everything. And so the reason why we're talking about this specifically is more in the reason as to why. Why is the financial system that we have completely corrupted to the core? Not just corrupted from the people that run it, but it's inherently flawed, the fact that anybody runs it. Why? And why a new system that nobody can control would be such a better system. Now, a lot of people don't understand this because they don't understand how the financial system works. They don't understand how these problems that these central bankers cause by arbitrarily changing the monetary supply whenever they feel like it. They don't understand how that impacts them. And so a lot of times when you present people with a better solution, how maybe going back to a gold-backed currency might be a better option, or going something to like a decentralized ledger like Bitcoin that nobody can control, how that might be a better option, they can't understand that because they don't understand the problems that the existing system is causing in their own lives. And so we spent a lot of time talking about that. And so I want to dig through that. I want to talk about what's going on with the financial system, with inflation. We're going to talk about what the central bank, what the Federal Reserve is saying. I got some audio clips that I'm going to play for you. Jerome Powell, head of the Federal Reserve, was testifying before Congress today. I pulled some clips for that. I want to go into somebody that we should be listening to. He is a former head of the New York Federal Reserve, head of the FMOC, Federal Open Market Committee Board, previously with Goldman Sachs. I mean, this guy is connected, and we should listen to what he has to say, and I'm going to tell you what he has to say because you should be listening to it. We're going to talk about some warnings that Ray Dalio has been giving us. Now, Ray Dalio is one of the richest men in the world. He's head of the largest hedge fund in the world, Bridgewater Capital. And when he talks, people tend to listen. I tend to listen. So I'm going to talk about some things that he said. I got some more clips that we're going to play for you. And then we're going to talk about the state of the markets that we're in today, what the Fed can and can't do, what they will and won't do. Talk about the danger in the illiquid markets. Talk about how that affects the cryptocurrency markets and general markets overall. Yeah, let's get back to it. We're talking about inflation, again, for the 8th month in a row, but talking about it in a different light, in a different way. And so, like I said, first of all, the Federal Reserve, the central bank, they are tasked with two main things. It's called a dual mandate. So mandate number one is stable prices. So like when gas doubled, that's not very stable. When the price of real estate doubled, that's not very stable. When every time you go to the grocery store to buy milk and cheese and bread and meat, your bills are more expensive. Every time you go to fill up your gas tank, you get less gas in your car. That's not what I would consider stable prices. So if I had to give them a score of, like school, I'd probably give them a F, a failing grade on that, because prices are anything but stable. Now, I guess if you want to look at it on a sliding scale, it's a little bit more stable than Venezuela, but that's a pretty low bar to meet. We're going to talk about that. We're going to talk about, like I said, I have these clips that I want to play directly so you can hear directly from their mouth. Some of the questions they were asked from the committee. We're going to look at some of the Fed insiders, what they told us that's coming. I take them at their word. I listen to what they say, and I prepare for it. And I'm going to tell you what they said, and you better be prepared. And here we are, way too much inflation. And so now they're like, oh, shoot, it's way too high. What are we going to do about it? And, instead of operating with the precision of a surgeon with a scalpel, they're operating with a hatchet. And so they couldn't get to the 2% number they wanted. And so they said, screw it. Let's just throw everything against the wall. Let's just let it run hot, right? And they did. And now we're at 8.6. So they way overshot the goal. As a matter of fact, they overshot the goal by hundreds of percent. Not just a little bit. They overshot it by a lot. The goal was 2%. Here we are, almost to 9. Not much precision. So now another knee-jerk reaction. Now it's a problem. The problem was before we couldn't get it. Now the problem is we have too much, and we can't get it back to 2%. So let's just smash it as low as we can again. And who cares what happens with everybody else in the economy? And unfortunately, that's where we're at now. A lot of people are waiting, hoping that the Fed is going to pivot. The Fed is going to go back into their Fed put. The Fed is going to just say, forget the inflation. Let's just pump the markets back up. But I'm not so sure about this. Now, I got a couple clips that I want to play that I think helps illustrate this if you want to understand what's going on with inflation. And if you understand what's going on with inflation, then you might understand what the Fed is going to do. So the first thing, like I said, Jerome Powell was sitting down with the committee today. Let's play one clip that I have right here so we can start to understand what they're dealing with, what they're looking at, and what this means to us. Here we go.
Inflation is just an imbalance of supply and demand. Can we agree on that?
Yes, generally.
All right, so that's Senator John Kennedy, and he is questioning Jerome Powell. And he says, "Okay, look, you're trying to fight inflation. So let's talk about this." He says that inflation, meaning prices going up. It's not really the real definition. I'm not going to get into that right now. But he says inflation, prices going up, is really imbalance of supply and demand. So look, man, these PhDs at the Fed, they want to make this super complicated. It's not. It's super easy. All prices are derived from supply and demand. Now, there's trillions of reasons why supply and demand could change, but ultimately it comes down to supply and demand. So he asked that question. He says, so all inflation is an imbalance of supply and demand. So if there's more supply than there is demand, prices come down. That's the imbalance. Or if the imbalance works the other way, if there's more demand than there is supply, then prices go up. If there's 10 people trying to buy a house, but only one house for sale, 10 times the demand, one house, the price is going to go up. It's going to get bid up. If the opposite was true, the imbalance, to his word, was the other way. There was 10 houses for sale, but only one buyer, the prices would come down. All right, so that's what he's saying. And Jerome Powell, you heard, he says, yes, that's right. All right, so now let's play this next clip here, which I think is pretty telling. So here's what the Fed is doing to get their prices stable again. Let's check it out here.
Demand's up here, supply's down here. You're trying to lower demand. Is that correct?
Yes.
So if the imbalance is off, causing the prices to go higher, then you have two levers. You can either increase, you can try to solve the imbalance, right? So in this case, you could increase the supplies, but of course the Fed can't do that. So if energy and food are too high, which of course they are, then they could increase the supply of those things. But the Fed can't print food and they can't print energy. And so they have the other option, which is to lower the demand, or what's actually called demand destruction. So if they can't add more supply, let's just make you broke so that you can't even afford it. Now, I know that sounds pretty drastic, but that's exactly what he just said. As a matter of fact, I got some more clips. Before we get into that, though, let's hear from somebody that you should probably be listening to. And so we saw Bill Dudley. Now, Bill Dudley might not be a name that you know, but you probably should, because you want to listen to people who are very influential. So, for example, I've talked in the past about Mark Carney. Most people don't know who Mark Carney is, but you should. He's one of the most influential people in the whole world. I'm not going to get into Mark Carney right now, but Bill Dudley is also pretty influential. So, like I said, he was former Federal Reserve Bank of New York president. So, of all the Federal Reserve banks, I believe the New York Bank is probably the most important, the most powerful, most influential. So, he used to be the president of the Federal Reserve Bank of New York. He also was the head of the FOMC committee, the meetings, which sets the policies on this. That's also a pretty important position. And he worked at Goldman Sachs. So if you worked at the government and Goldman Sachs, that means you are pretty dang connected. And he says that, let's see here. He says the Fed, quote, hasn't really accomplished much yet with its efforts to control inflation, and will need to tighten financial conditions to push bond yields higher and stock prices lower. This is where it gets good. Quote, if financial conditions don't cooperate with the Fed's going to have to do more until financial markets do cooperate, end quote. So what is he saying there? He's basically saying that the Fed will need to force stocks lower. They'll have to force it, which is what Senator John Kennedy was saying. You can't increase the supply, right? So you're just focusing on the demand side. And Jerome Powell replied, yes, which is what Bill Dudley says, which is we might need to force stocks to fall. Why would forcing stocks to fall lower demand? Well, it's demand destruction. It's something known as the wealth effect. And so when your stock account goes up, when your retirement account goes up, when your home goes up in value, even though you weren't planning on selling your home, most likely, right? It's just your house. You weren't planning on selling it, but it went up in value. You feel wealthy. You see your retirement account go up. You're not planning on cashing that in, not until you retire, but you feel wealthy. That's the wealth effect. And when I feel more wealthy, I spend more money. And that creates more demand. When I feel broke, when my house is upside down underwater, when my retirement account drops to a level that I can't retire anymore, then I feel broke. Even though I wasn't planning on selling those assets, I still feel broke, and now I'm not spending the money, so now I'm not putting as much gas in my car, I'm not taking those vacations, I'm not going out to dinner multiple times a week, etc. Demand destruction through the wealth effect. Now, like I said, I'm playing the clips because I want you to hear it from their mouth, not from mine. That's exactly what Senator John Kennedy asked Jerome Powell that he replied to. Now, I got some more warnings coming up from other people you need to listen to, and I got some more clips so you can hear it directly from their mouth. And they're trying to bring inflation down because, of course, of their dual mandate, one of which is stable prices, and prices aren't stable. They're going through the roof. And so they're trying to bring prices down, but they can only bring prices down through one of two ways: increasing the supply or taking away the demand. Of course, they're choosing to take away the demand. I played you a clip of Jerome Powell admitting so much. And Bill Dudley, former Federal Reserve Bank of New York president, said the same thing, that they would have to force stocks down, which is exactly what's happening. Now, we have another warning from somebody that we should all probably be listening to, and that's Ray Dalio, one of the richest men in the world, the head of the largest hedge funds in the world, Bridgewater Capital. And when he talks, I listen. I just finished reading his book, which was he has a new book out, which is amazing, packed full of charts and graphs. Definitely a good read. But he says that Ray Dalio says reducing inflation will come at a great cost. So if you want prices to come back down, we can do it, but it's going to come at a great cost. Now, what's that great cost? Well, what did Bill Dudley say? The Fed will need to smash stocks lower. So what does that mean? What's this great cost? Well, that means wiping out your net worth, wiping out your ability to potentially travel, or potentially retire, potentially send your kids to college, or pay for your daughter's wedding. I mean, who knows, right? Let's take a look at what he says. He says that the Fed is likely to chart a course that leads to stagflation. Now, stagflation, I don't know what you think about that word when you hear it, but it is not a good thing. Now, we haven't seen stagflation in the United States since the 70s, but of course, Japan has been dealing with this for quite a while. What is stagflation? It's stagnant economy with inflation. So that means prices continue to go up while economic growth goes down. It's the worst combination. What you would want is economic growth to get better and prices to come down, and that would lead to massive human flourishment. That would mean that you would have to work less hours to improve your quality of life. That means that your life gets better over time and not worse. But no, the opposite of that is economic growth goes down, you make less money, and things get more expensive at the same time. That is a horrible combination. That's where Japan's been. The United States was there in the 70s, and Dalio says, the Fed is likely to chart a course that leads us to stagflation. Now, why do we talk about this, again, if you're just tuning in, why do we talk about this when we're talking about a decentralized revolution? We're talking about sound money. We're talking about things like Bitcoin. The reason why is because this is the problem that the central bankers cause by increasing the money supply and decreasing the money supply. Jerome Powell is crashing the markets. As Dalio says, the Fed, the Federal Reserve, is charting a course that leads to stagflation. How? By decreasing the money supply after they had increased the money supply. It's ridiculous to think, when you understand what's going on, that we have a group of people that arbitrarily just increase the money and decrease the money and send us to booms and busts, and they cause massive destruction in their wake. And that's where we're at. Most people don't understand how that works. Of course, they don't teach you that. And that's why we're breaking it down for you here. So anyway, he says that they're on the course to chart a course to stagflation. I don't want to go into stagflation. You don't want to go into stagflation now that you understand what it is. So why should we have anybody able to chart us a course there? Because I don't want to go there. You see what I'm saying? The ridiculousness of having anybody control the money. Ray Dalio says, he wrote Tuesday on LinkedIn, it's naive, quote, it's naive and inconsistent with how the economic machine works. So it's naive. He's calling the central bankers a naive. So, I mean, I haven't used that word. That word might be a little nice. I would call them either stupid or, I don't know, evil. They either don't know what they're doing or they're doing it intentionally, right? And in my opinion, both of those are maybe equally as bad. If they don't know what they're doing, then what the heck are they doing there in the first place? And if they're doing it intentionally, then what the heck are they doing there, right? Either way. So he calls it naive, okay, a little bit nice, to think that the Federal Reserve raising interest rates will, quote, will make things good again once it gets inflation under control. So he says, look, if you think the Fed raising rates to try to get inflation under control is going to make things better, then you're naive and you're inconsistent. You have no idea how the economic system works, which of course is their whole plan. Of course you don't know how the economic system works because no one taught you that. They specifically withheld that information from you, and any information you did get was completely misleading. For example, teaching you Keynesian economics. I put out a tweet maybe a week or two ago. I said the greatest trick the Federal Reserve ever played was teaching you two things. One, that the money supply has to always expand for things to get better. And two, that assets like your home going up in value is a good thing. Now, a lot of you people might be listening to that and go, what the heck, Mark? You have no idea what you're talking about. Of course the money supply has to expand. It might be naive and inconsistent with how economics really works. That's what Ray Dalio is saying. By them arbitrarily increasing the money supply and then decreasing the money supply to get inflation under control is not going to make things better. That's what Ray Dalio is saying. So take it up with him. He says, while tightening leads to less consumer spending, right? You take the money away and then nobody has money to spend, which may reduce inflation, it doesn't make things better. So if you take away people's ability to spend, I guess it lowers inflation because now no one's buying anything, right? But it doesn't make things better. And as a matter of fact, it makes things worse in a couple of ways. He says, quote, it shifts some of the squeezing of people via inflation to squeezing them via giving them less buying power. So what happens is when prices are going up, they're being squeezed by inflation. Prices are going up so fast they can't buy enough gas, they can't buy enough food, they can't run their air conditioner or their heater when they need to. So you're squeezing them that way. But then you squeeze them by giving them less buying power. Now they don't have any money. So what's worse? Things are too expensive or I just have no money altogether, right? Either way, it's a problem. Now, what also we're starting to see, and I believe this is going to continue, is that by them trying to smash the stock price down, like Bill Dudley says, or take away the demand, like Jerome Powell says, they can actually make prices go up even higher, not lower. So, for example, they push the demand low, you're broke, gas prices go up, you can't buy as much gas, now you can't commute to work every day. So I'll just quit my job and live on unemployment. So now there's less people working at that job. Now that employer now has to find more people. He has to pay them more wages. If he has to pay more wages, his costs go up, and now he has to increase the price of his goods and services to pay for that offset. So by prices going up and them coming out and not buying that product, it pushes the prices up. Supply chains start breaking down, etc. Not enough people working at the refineries to make enough gasoline or unload the ships at the dock, and so that pushes prices up. So they're doing these things to try to bring prices down by destroying demand, but they destroy demand so much that it actually pushes prices up. It's quite the conundrum they're in. And hopefully you start to understand why it's completely insane to think that we need a group of people managing the money supply, right? Let's play another clip that I have here ready to go, and we'll see what he says here. There's another way that they could do it. This might be a better way.
The two aren't exclusive. You alluded to that. You can also lower demand, but you can increase supply. Can you not?
Yes.
And that would solve inflation.
Yes, it would.
Who would have thought that? Maybe if we had more abundance instead of scarcity. Maybe if instead of smashing people's ability to buy the things they want and live a good life and making them live a life of poverty to fight inflation, how about if we just added more supply? How about if we just went back to a day that didn't seem like that long ago when we actually had enough energy? That would be a novel concept. Imagine going to the store and like having all the stuff that you wanted to buy on the shelves like we did so long ago, like a year ago. How about we just give them more supply? But how can that be done? Of course, that's the difficult part of the equation, right? Well, not really. Now, before the break, I was talking about supply and demand imbalances. Senator John Kennedy has been questioning Jerome Powell of the Federal Reserve, and he says, hey, look, it's an imbalance of supply and demand, obviously, and you're smashing demand to try to bring prices down, but couldn't we just also add more supply? And Jerome Powell says, yes. As a matter of fact, we can. But it's not just that easy. They can't just add more supply. You have to understand that the government cannot create anything. The government doesn't make anything. They don't produce anything. The government cannot give something that it has not taken. So all the government can do is redistribute. It can take money from the wealthy, from the wealth creators, and it can give it from the creators to the consumers over here. It can do that. It can regulate. It can create all kinds of red tape, but that only makes it harder to produce. Like, for example, the problem, there's a quote that I've been saying quite often. I might have said it here on the radio. You might have heard it, and I'm sorry if I do, but burn it into your head. And it's from Ayn Rand. It's from Atlas Shrugged, and she says that when you have to get permission to produce from people that produce nothing. And that's exactly what's going on today. In order to produce a good, I have to go get permission from government regulators. They've never produced anything in their life. They don't know anything about business, but I have to get permission from them. And so all of their regulations and their rules and their policies they put into place cause prices to go up to navigate all that red tape. Now, Senator Kennedy, he's onto something. John Kennedy, he's smart. Let's play this next clip here, and we'll find out.
If we reduce the regulatory burden, let's say on refineries, wouldn't that incent refineries to start refining more and help on the supply side?
Imagine that. If we remove some of the regulatory burden, maybe producers could actually produce more, and that would help the supply-demand equation imbalance by bringing more supply into the market. Remember, the Fed can't create anything. The government cannot create anything. All they can do is regulate how we do it and redistribute it. So all we need for them to do is remove their boot off the neck of the producers, and they could just produce more, like Senator John Kennedy is saying right here. And that's exactly right. And like I said, this goes back to the insanity of having a group of people, central planners, central bankers, planning things that control your life. So now you just have to be okay not taking that vacation this year and not getting the type of food that you want on the shelf and not getting, not driving on a trip this weekend or whatever it is, because these central planners said so. Because in their infinite wisdom, they think that's what's best for you. Now, in my opinion, nobody knows what's best for me except for me. Now, I can meet with experts. I can meet with my doctor to see what he thinks, and I can meet with my financial advisor to think what he thinks, and I can meet with my wife. I should probably do that to see what she thinks. I can take all that information into consideration, but at the end of the day, I have to make the decision what's best for me. But here we have central planners making the decisions that affect your life no matter what. They increase the money supply, they decrease the money supply, and that is sheer insanity. And that's why we are talking about Bitcoin. I've been a gold bug. I've been a sound money advocate. And we need to take away their ability to do this. Sound money. So all of these issues are derived, like I said, from the Fed creating money from thin air, increasing the money supply. They don't increase the money supply like pulling money out of their savings and putting it out. No. They arbitrarily create it out of thin air by issuing credit. So all of our money is debt-based. So when you go to the bank and you take a loan to buy a house, a car, a boat, RV, whatever, that money is created into existence. And so they're basically creating money from thin air. Now, whenever you have a group of people that are forced to trade their time for money, and you have another group of people who can create money from thin air, it leads to slavery every single time. Nobody should be able to steal the fruit of your labor by arbitrarily creating money out of thin air, but that's the situation that we're in. And when they create this more money, it creates all types of imbalances. It creates way more artificial demand. That's one of the issues, right? So that increases the demand side, which causes price to go up. But it also creates all types of other effects. Trying to understand this, understand why price is going up. First of all, the Austrian economist's view of inflation is when the money supply increases, not CPI, not price inflation, not consumer prices going up. It's when the monetary supply increases. That's inflation. The effect, asset prices going up, consumer prices going up, that's the effect of that. You can't measure that because there's trillions of prices brought on by trillions of inputs that have a trillion reasons as to why those assets would all go up. And so having an arbitrary group of central planners, of central bankers that can arbitrarily decide to increase the money supply at their will and decrease the money supply at their will continues to create these imbalances that they see fit, which is not a system that I think is fair. I would much prefer to have a system that nobody controls. But what do you think? I'd love to have your thoughts on that and more. If you're not already following me, you should hit me up on Twitter at @1MarkMoss. That's at the number 1 Mark Moss. Hit me up on Instagram there as well. And thanks so much for listening to the Mark Moss Show, talking about Bitcoin, talking about the decentralized revolution, and talking about the way the world is changing through politics, finance, and technology in a world being driven by out-of-control central bankers. That's what I got for you today. Thanks so much for listening. Since you've stayed to the end, I know you like this video, which means you're probably going to really like this video right here and this video right here.